So welcome everybody. Thank you for joining today's session on transitioning to employee ownership. We're joined today by Adam Rollason, who's a tax partner, Darren Hodson, the corporate finance partner at PKF Smith Cooper. Adam and Darren regularly advise own managers on the sale of their businesses into EOTs. They're going to talk us through the process and some key considerations. And what we'll do after the presentation, we'll open the floor to questions. So if there's anything you'd like to ask, just put a note in the chat box and I'll try and work through it in order after the presentation. Then I'll come back to you so you can ask the question directly. Over to you, Darren and Adam.
You want to start, Darren? Shall I start?
I think if you start, Adam.
Okay, fine. Thanks, Ben. Thank you, everyone, for joining. I was just saying to Darren 10 or 15 minutes ago before we started that this is really bad timing to deliver this this chat today based on what happened in the budget yesterday. But I think actually, if you look at it, it's probably really good timing. What I think we're going to struggle with is having the answers to all your questions based on what you may have seen coming out of yesterday's budget, because we're going to have spend some time reading around it. We can certainly touch on things at quite a high level, but most of what you'll see in the slides is everything that applied up to midnight the day before yesterday. And yeah, there was quite a big announcement yesterday, which we'll sort of touch on. But just to introduce myself, tax partner at PKF Smith Cooper, working in tax for 13 years. I'm a specialist in M&A tax, so EOTs, management buyouts, private equity investment, third-party sales. Spent most of my career here, Grant Thornton, RSM, and did a few years in a law firm in between as well.
Yeah, thanks, Adam. And as Ben had already said, I'm corporate finance partner, so I'm a lead advisor that supports on buying and selling businesses, and that includes one of the options, which is becoming a bit more flavour of the month, should we say, and may be impacted by the budget yesterday, EOTs. So we've supported on some EOTs. We deliberately put this in after the budget. I think it was originally scheduled pre-budget, but after the budget, just in case. We weren't expecting any changes, so we're a bit surprised that there were some, but at least we've kind of timed it as best we could. Just a very quick thing. So PKF's big global firm. So we've got a lot of expertise. We operate nationally through lots of different offices, and a bit like the header at the top, we're doing lots of deals. So this is not just EOTs, but large scale deals. So we see quite a lot, which is why we get a flavour of what's hot for different clients. But if we kind of delve into EOTs, Adam?
Yeah, sure. Appreciate that we haven't got a lot of time, and I could on my own talk to you about EOTs, and with Nick, my colleague that's here as well, we could talk to you about EOTs all afternoon and you'd probably all fall asleep. So we are going to canter through this at quite a pace. So we will try and pick up questions at the end, but if anyone wants a more detailed discussion, we're happy to do that outside of this forum as well. But just to sort of take these points one by one, and then I'll get Nick to quickly run you through the qualifying conditions sort of section. But what is an EOT? It's Employee Ownership Trust. Effectively is a structure that was introduced back in 2014, effectively to promote employee ownership and within sort of privately owned businesses, and is becoming more popular as an exit route for owner managers. We always used to talk about John Lewis and the John Lewis model when we talked about EOTs, and that's broadly what it was designed on originally, but I think it's probably moved on a fair bit since that. Why are they becoming more popular? Until yesterday, they were becoming really popular because last year in the budget, the main rate of capital gains tax was increased to 24%, and up until yesterday's changes, sales to an EOT were CGT free. So that's why they were becoming more and more popular. One of the reasons they were becoming more and more popular, because actually they were really efficient from a tax perspective. To be able to do one of these and qualify for what is still a reduced rate of tax, you need to satisfy certain qualifying conditions. One of the reasons that we felt that there wouldn't be a lot of changes yesterday, or any material changes yesterday, was that there was a significant tightening of the rules in last year's autumn budget. And we've spent, Nick and I spent 12 months getting to grips with all the changes and starting to see them flow through transactions. And we thought nothing had really changed before that. So we almost had 10 years of no change. Then we had the overall last year, and we just get to grips with that. And then that's why we thought nothing was really going to happen yesterday, and it has. Disqualifying events, effectively disqualifying events means that anything that happens after a sale to an EOT that's taken place, which could impact the tax relief effectively. We'll touch on that as well. Commercial considerations and the funding of the purchase price are the sections that Darren's going to cover. Can we move to the next slide, please, Darren?
Yeah.
So for all of you that are visual learners, I think this is quite a good slide that captures effectively what an EOT is and how it works. But on the left side, we've got a trading entity that is owned, let's say husband and wife in this instance, 50%, 50%, and they're looking to exit. Perhaps they've sort of run a process and there's no third-party buyer. There's no interest or appetite for a management buyout, for people to effectively be putting PGs on the line or remortgaging houses, etc. And there's no bloodline succession within the family. So they've decided that an EOT is a good transaction to do because it probably means less personal liability for employees. And actually, they do want to reward the loyalty of some of the employees that have been there for a long time, or all of their employees, as we'll come to. So effectively, they sell their shares. So in this example, we're assuming 100%. They sell 100% of their shares into an employee ownership trust in exchange for a cash payment, typically on day one, and deferred consideration over a period of, most of the ones that we've done are somewhere between 3 and 10 years. And effectively, before yesterday, that was completely tax-free. So whatever comes out on day one in cash is tax-free. And then all of the deferred payments over that 3 to 8 year period were also tax-free. Next slide, please.
And that change, Adam, to now, they've kind of increased the rate, haven't they?
Yeah, so effectively what happened in yesterday's budget was, I've been sort of saying to clients for a while, because of how popular these are becoming, they're losing out on a lot of capital gains tax. When you look at an equivalent transaction, perhaps a management buyout transaction or a third-party sale, that would be subject to 24% tax. So I did think at some point, I thought yesterday was too early because we've not really seen it come through. You've almost got to go through a tax return cycle to see this. So I thought, this is something that will take a couple of years to come through for them to cotton on to, that actually they're becoming more popular. They're therefore losing a lot of capital gains tax, and therefore they need to do something. But I'd said to a lot of people, an easy thing for them to perhaps do is change that 0% to perhaps a 10% rate. And that's broadly what she did, albeit with a 12% rate. But the way that she did that was to say that 50% of the gains arising on sale into an EOT now is going to be tax-free, and the other 50% is going to be taxable at the main rate, which is 24%, which when you look at that sort of across the whole gain, it's an effective 12% rate, which is 2% more than I'd sort of originally predicted that she may do in the future.
And there's no badder available either on disposals to an EOT. They've specifically sort of ruled that on.
Badder, for those of you that think what's badder, that's business asset disposal relief, which used to be called entrepreneurs relief.
Much better name.
Yeah, used to be 10 million, now 1 million, but specifically we've worked out this morning is precluded from applying to any transactions where 50% of the gain is taxed at 0%. Qualifying conditions, Nick, if you want to do that.
So I'll run you through these quite quickly. Because the tax relief is still pretty generous, even given the changes that they've brought in from yesterday, there's a lot of detailed conditions that need to be met in order to get access to the relief. This is just a very high level review because we haven't got the time to go into them in great detail. The first one is the relief is only available when an individual sells their shares. It's not available to companies. In most cases, because of the type of companies that qualify for this, if a corporate held shares, they'd probably qualify for SSE anyway, so the substantial shareholding exemption. So it's likely any sort of disposals by companies would be exempt from corporation tax. The controlling interest requirement's pretty self-explanatory. You have to sell more than 50% of the shares cumulatively into the EOT, enabled to be able to benefit from the relief. It gets quite messy if you do sort of 51%. I think when these first came out, a lot of people were doing that. Given the changes that they brought in the 2024 budget, if you're going to sort of then later buy the additional 49%, that can now be quite tricky to do without incurring sort of tax charges on the trustees themselves. The trading requirement is basically the same as BADR and Entrepreneurs Relief. It has to be a trading company. So if you've got property investment companies or other types of investment companies, you can't benefit, or the shareholders can't benefit from this relief. The UK resident trustee requirement was one that was brought in the budget last year. What was quite common with these was to have a non-UK resident trustee, basically because non-UK residents trusts aren't liable to UK capital gains tax, and if a disqualifying event occurs within a certain time period, that could crystallise a CGT charge. They've stopped that now by saying in order to get access to this relief, you need to be, or the trustee needs to be, UK resident. Most of the time, the trustee is a company limited by guarantee. It doesn't have to be, but for sort of liability issues, that's generally the way we would sort of structure it. The all-employee benefit requirement's probably the most complex of all of them. Its broad intention is all employees of the company have to benefit sort of under equal terms. It doesn't mean all employees have to get the same in terms of bonuses and things like that. But in certain cases, certain bonus payments sort of are tax-free up to £3,600, and there's sort of conditions in the legislation that have to be met in order to get access to that treatment. The trustee independence requirement, that again was something that was introduced in the budget last year. That's broadly been brought in to prevent people selling the company to an EOT, banking the CGT relief, and then sort of retaining control of the company through the back door. In practice, the way we usually sort of see this is because most of the trustees are companies limited by guarantee. It means the board of that company, so the board of the trustee company, basically has to consist of a majority of people who weren't shareholders in the company that's been sold. So typically what we see is one former shareholder, very often an employee of the company that's been sold who wasn't a shareholder, and some sort of third party, so very often a solicitor or an accountant or somebody like that to sit on the board of the trustee company. The limited participation requirement is essentially no more than 2/5 of the company's workforce can be shareholders. So if you've got sort of a company with only, say, 6 employees and 3 of those are shareholders, they can't benefit from doing this. It's generally geared towards companies that are a bit bigger than just a few employees. And the market value consideration and interest requirement is broadly, again, it was something that was brought in the budget last year to sort of stop people selling the companies in for sort of overvalue. So if you've got a company worth, say, 4 million and you sold it in for 5, you'd obviously sort of benefit from that. There was always a general law point of, well, it's against trust law to actually for the trustees to pay that, but they've specifically brought that in as a condition of the relief. Now, The way that's often met is you get an independent third party to value the company. They produce a report, and the company is then sold into the EOT or to the EOT for that value. And that's more or less a high-level overview of those.
Yeah, and then the next bit is kind of, there's a lot on this slide again, but it's what we tend to typically see now as some of the preferred structures. I mean, there's a lot of way you can structure the EOTs, but if you kind of focus down on stage 2, basically it's very similar to a management buyout. So if people are familiar with a buyout fundraising, well, it's remarkably similar. So you've got to find the purchase price, perhaps working capital, and perhaps deal fees, and that's what you're funding. And how can you fund it? You can use external debt. So there are debt providers that will lend to EOTs. You can use cash reserves. There is potential for management equity, but I'll come back to that. And vendor rollover. So what we tend to see is either vendors will roll over 100%, and basically before yesterday's budget would take out essentially the all their income going forward tax-free until the deferred's paid off. But now clearly we've got this tax change, so there'll be a 12% hit on that. But also you can use the third-party debt to get a bigger day one slice for the vendor. And again, that's about if you're an FD in the business, making sure that's the right level and comfortable with it. And what we now tend to see in box 3, where stage 3 is more complicated EOTs. So Adam talked about an EOT buying 100%. I think broadly, yes, we see that, but actually it can leave a target rudderless. So what happens to the management team? Are they appropriately incentivized? So what we're seeing is an EMI structure which is put in place at the target that gives management an equity participation. So as long as management don't take control of the business, i.e. go over to the 51%, then you should be able to get an EMI in, and clearly there's qualifying conditions for an EMI as well, which we're not going into on this call. But actually, fundamentally, therefore, the EOT, I mean, we were recommending a 60-40 rather than a 51-49, and we think that's passable for HMRC to make sure you stay within the guidelines. And management can crystallise that EMI at a point in time in the future, and we set the rules. But also, they can sell their shares back to the company, essentially the EOT gradually taking back 100%. So that there's a kind of a neat solution exit path for that management team, and clearly you can continue to recycle that over a period of time, bringing through the more management team members. The essence of it, though, is all in that first bit, the commercial setup, which we haven't got time to go through today, but there's quite a few things to think about around, if a vendor has got deferred consideration, they can't have control over this business, but they can have negative control. So I equate that to PE type restrictions where you can say, well, actually, we get a veto on whether there's an acquisition undertaken, or we take on new bank debt, or things like that. So there's areas of protection that you can bring to bear on this. Also, you can see on here cash sweep. So this is quite a favoured mechanism from the companies we're talking to, which is a lot of vendors don't want to overburden a company with debt, and the cash sweep allows you to sweep cash at the end of a year, subject to being free cash. So, and maybe leave some in the business. So actually you start getting a fair balance, and that cash sweep mechanism is quite a good mechanic for that. And then the rest really kind of comes down to, do the vendors want to sell all of it or some of it? They can't have any security in this because it starts encroaching on who's in control of this business. You can still control management and have leaver conditions. So all of those kind of things can still come to pass. But that's very high level that, these are fundable structures, and you can get a management team into the equity. And So a bit like Adam said, what we found with management buyouts is a lot of management team members don't like the hurt that a bank might ask them to put in, and that doesn't exist really in this structure. So there's a way to get management into it, if the vendors wanted to, and if the management team wanted to. So quite a neat structure, less tax effective than where we were before, but probably still appealing to a number of different vendors. And it's a transaction that's in the vendor's control. So it's something, yes, you've got to hit all the tax regs and there's a lot of tax advice you need, but you can go and achieve this relatively quickly compared to taking a business out to market. And clearly it's a little bit less sensitive as well doing something like this. Adam, I don't know if you got any final thoughts. I know we're into Q&A now.
No, not really. I think there's probably a reference at the start, a lot of work to be done on sort of unpicking the impact of what was announced yesterday. I think, as I said, we've spent most of the last 12 months getting to grips with the changes from last year and just making sure that we're still meeting all of the new conditions. And then, just as we're getting to a point where I think we have got to grips with it, I think they hit you with something else. But I think I've had a couple of calls this morning, and I think the big things that are coming out of yesterday's change are if we've now got a tax charge on 50% of the consideration that's going to be paid out, when's that tax going to be payable, and how's it going to be funded? So I suspect that this could evolve again, and we might start looking at switching out some of the deferred consideration, perhaps for some loan notes. And we just need to spend some time looking at it and probably see how that evolves over the next few months, really. But I think back to your point, Darren, I think a 12% rate it's exactly halfway between, and that's what she's done here. I think if you're selling your business and you pay 24 and you sell it to an EOT and you pay 0, doesn't really seem right. So if everyone's sort of picking up a bit of pain with the current economic climate, then perhaps something should be paid on a sale into an EOT, and she's gone right in the middle at 12%. So,
great stuff. Thank you.
Do we
for
have
that.
any questions?
Down, Adam, Nick. If anybody's in the chat, then I'll try and work through in order so you can ask the question directly. There we go. So we've got Eric who's just asked this question there. Eric, do you want to unmute and ask your question directly? Eric, are you?
So there's a couple of questions in the box, isn't there?
Yeah.
So there's one which is, can an EOT work if there's only 2 employees?
I think the answer to that. Do you want to pick that on me?
Theoretically, yes, because if as long as the other employees aren't linked to the owner, but in practice, I think it'd be quite difficult. We've never seen one that small.
Yeah.
So like I said, you have to be on the sort of 40%, which you'd be 1/3, so 33%. Yes, theoretically, but we've never seen one that small.
The next question is, will 12% rate impact deal in terms of future deferred consideration?
No, so it's anything that completed before yesterday benefits from the old rules. Anything that completed from yesterday is done under the new rules.
So Paul's asked, it's very tax efficient. Can this not be seen as a shadow distribution?
So we typically go for transactions in securities clearance when you do this, just to get some comfort around that they're not going to sort of try and seek to tax it as that. If you're selling more than 75% into the EOT, you should benefit from the fundamental change of control provisions. So you wouldn't necessarily have to go for clearance if you're selling 100%. We always do, because we just think it's an extra level of comfort. But it's not. If you're only selling
And it
51%,
should
then
be,
very much we recommend doing that, or sort of 60%, because you don't fall within the automatic sort of TIS exemption.
and this is a government-driven scheme to get more employee ownership into the shareholder structure. So, I think it's looked on favourably by HMRC because fundamentally that needs to happen as part of it. So, I'd, it all depends on the scheme. Some people have abused these schemes, but the fundamental principles are right and supported by HMRC. So my instinct is also no on that. There's another question, which is how does EOT compare now versus EMI, considering
So
the thresholds yesterday?
they're trying to achieve different things, really. So an EOT is an indirect form of employee ownership. So the employees don't directly own any shares in the company. They indirectly do through the trust, and essentially the trust has to run the company in a way in which benefits the employees. EMI is very much more, it's targeted at key management personnel. It gets them shares directly. What they've essentially done yesterday with the EMI stuff, and I believe this comes in from April 26, is increase the limit. So it's now available to bigger companies than it previously was. But whilst both are sort of designed to try and encourage employee ownership, EOTs are much broader than EMIs, because sort of all the employees can benefit, whereas EMIs are very much targeted at, we've got 3 or 4 members of key management, maybe a few more. We want them to benefit from a future sale, and that's where EMIs sort of come into their own.
It's probably worth saying the trust that runs the EOT, you could have a vendor in the trust, you could have an employee and an independent trustee. So those 3 could be making the decisions on behalf of the EOT. So you've got different influences there, that kind of cements what Nick was just saying around who actually controls and runs the EOT. And the idea is the benefits try to get to the employees. But I think Adam had said this to me more fundamentally on EOT, that actually what's really happening here is the vendor or the vendors are passing on their CGT liability to the employees. And that means when the trust has to make a decision on the future of the business, there's quite a big tax burden on the employees if they were to sell it. So if you were truly looking at it independently, are you going to sell a business that ends up with a 60% tax charge, or whatever the end result is? The question is no. So I think a few years ago, me and Adam didn't really like EOTs for that purpose, that you didn't have the exit route. But the combination with getting an EMI in place and incentivizing select people, and giving that management team a way out is actually quite a good structure, and they do complement each other. So I'll just say that in terms of that incentivization package, they're very different things.
Great stuff. Thank you. Any more questions from anybody? No more in the box, but we've got a couple of minutes. Oh.
So how do you control the EOT EMI split to allow for new management to join EMI scheme?
So initially, sort of what tends to happen is you put 100% of the shares into the EOT. That exits the existing shareholders. An EMI scheme is then put in place over shares that are going to be newly issued by the company itself. It's very important that they can't really be satisfied by the shares held by the EOT, because that would generally breach one of the requirements for the CGT relief. So the normally over newly issued shares in what's the target on that slide. Where it gets a bit trickier is once those shares are exercised, or once those options are exercised and the management have the shares, is then sort of bringing in the next generation of management, because EOTs are really designed to hold these companies long term, that they're not really designed to hold them for 10 years and then be sold. There's a couple of sort of routes that, I mean, we've not actually had one long enough to do this yet, but one possible route is the company buys the shares back. There are conditions to be met to sort of qualify for capital treatment on a buyback, I suppose one of the biggest ones in this case is that the management team need to have held the shares for 5 years. And that's 5 years actually physically holding the shares. That doesn't include the time that the shares were under option. The other sort of potential route is maybe to use, and some of you might cover your ears when I say this, but potentially use an employee benefit trust and have that warehouse the shares, and then you can always use those shares to sort of cycle between different generations of management. But that's quite complex or very complex. So yes, it's having share schemes in place. It works, but they come with their own issues.
I mean, I kind of just simply put it, we like the 60-40 split. So theoretically, you could go up to 49%, but that starts to break it fundamentally. So that's in whatever scheme, however you do it, that's probably the golden rule. You know, this is a complex structure that's put in place. So we definitely recommend taking advice on it, but that the EOT has got to remain in control.
We've got ones that are less than that as well. I think we've got another one at the minute that's 75-25. So it's sort of 40 to management is probably the highest number we're comfortable doing. But yeah, it can be less because you might say, well, actually, we just want management to have 10% between them, for example. But yeah, in terms of pushing it, 40 is sort of the top.
Ben, we've got a few more questions in, so should we carry on?
Yeah.
So at what point can a company be sold following an EOT? So there's nothing to stop the EOT selling it shortly afterwards, but broadly, if the EOT sells it within 4 years of the shares going in, the CGT relief originally obtained by the shareholders is withdrawn and the gain becomes fully taxable. If certain things happen sort of 4 years after they've sold it in, there can still be a CGT charge, but it arises to the trustees rather than to the shareholders. So essentially, say it was sold on for 10 million quid. What would generally happen is that the trust would crystallise a liability of say 2.4 million, assuming sort of very low initial base cost of the shares, and then the balance of the funds would then become distributable to the employees. But there's nothing to stop you sort of selling it quickly. It's just if that was done, the CGT relief is withdrawn, and there's normally always a CGT charge on somebody if the company is sold on, because like I said before, the idea of the whole employee ownership trust idea is it's held long term for the benefit of the employees.
I think that the other point to probably flag on that is the sellers would have paid 24% on a sale anyway to a third party. So I've got one client that's thinking of doing this, and we've sort of been through this, and he said, look, if something changes in the next 4 years and we decide the best thing to do is to sell the business, then I'm in no different position had I been if I'd have sold it anyway. So until you get to that 4 year cut off, and then the liability transfers to the trustees. But that 4 year window was 2 until last year. And that's now 4.
Yeah, they've extended it.
Yeah.
So we've got this question, which is, can a deal be done for less than 100%? The answer is yes, but our question is why? Because actually you can only do an EOT once, so the tax benefit is once, so you can do a partial sale. I don't think we've seen one, have we, Adam? I don't.
Yeah, we have done one, which is an IT business, which did 80%. It's messy for the reasons Nick said earlier, because you've then got a 20% stake withheld. You don't then get a second bite of the cherry, as you've just said, Darren. So you only get the tax relief on the 80. Then when you do effectively another transaction to get rid of the 20, it's, well, how do we structure that? Because where's the money coming from? So you get all types of sort of complexities that come with it. But yeah, you've got to do more than 51, but you can do less than 100 is the answer to that. Next one.
The next question is quite an interesting one, because we were discussing this given the chances that they've brought recently. So normally it would be sort of by the 31st of January following the tax year in which the shares are sold. So if you were to complete, say, I don't know, 31st of March 2026, the CGT due would be payable by the 31st of January 2027. Whether the issue with that is sometimes the initial cash payments are very low. It might be deferred over 10 years and you get 10% per year. So it's a good question as to, well, it's possible that in some cases you might not have actually had the cash to pay the CGT. So I've got a feeling this might be subject to a bit of discussion. There's a question as to could we roll into loan notes and defer it that way? We're not sure yet, because we need to sort of look over the legislation, and I think there's going to be some correspondence between the sort of professional bodies and HMRC to go back and say, well, making 50% of the gain chargeable is fine, but you need to bring in some sort of deferral mechanism so we can match the CGT with the payments. Now, there are a couple of cases where you can do that anyway. So we might be able to use those, but it's something that needs a bit of thought, that is, because it's a very good point.
Yeah, I think Rachel Reeves was on TV this morning being asked about, the mileage for the electric cars and how that's going to work. And basically, it was quite clear she didn't really know. If they're not having an MOT, and I've got the feeling they don't quite know what they've opened up with this, so I suspect there'll be more to come.
Excellent. Well, I think that's all the questions done now, I think. So thank you, Darren, Adam and Nick. And thanks to everybody for joining us today. There'll be a copy of this available should anybody want to look at it again later. We've got more events planned for next year, so do keep an eye out for those too. And also, you may receive a short survey at the end of this session, and we'd really appreciate your thoughts and if you can complete that for us at some point. But,
yeah, and apologies, this is quite a technical update, and I don't know whether it's too heavy or not for a lunchtime catch up.
Exactly. No, but it's all useful. Thank you very much, guys. It's been really useful.
Okay.
Thanks again to everybody for joining us, and have a great day.